I can see that we have a significant audience already part of the webinar as attendees, and that's why we'll just start off with the webinar. Thank you from IVCA for attending the regulatory advocacy update webinar. We just wanted to inform you that we do this on a frequency-based basis, wherein this is probably the fourth regulatory webinar that we are doing. For those of you who have recently become members of IVCA, we just wanted to highlight that IVCA stands as the apex association for alternative capital industry in the country, and our main foray is into policy making advocacy work for the alternative capital industry, along with engaging with regulatory stakeholder across the ministries as well as the principal regulator, which is SEBI. So we'll move on with the webinar. Just a rain check. We just wanted to inform you that at the end of the webinar, we'll be left with some time. So if you have any questions, do post those questions into the chat box, and we'll be able to take those questions in the end. Thank you so much. All right, so we probably wanted to inform you that our entire foray into advocacy in terms of engagement is right into the government of India, which is Ministry of Finance. So the PMO, as well as the Ministry of Finance, various departments within the Ministry of Finance, which is Department of Revenue, Department of Economic Affairs, DFS, CBDT, CBIC. Along with that, as a fund management hub, the newly created IFSC, which has taken shape now, we engage heavily with them as well. The principal regulator in India for alternative investment funds, which is SEBI, almost a daily engagement with those folks. Plus, from a capital infusion point of view, the triad of Reserve Bank of India for banks, Insurance Regulatory Development Authority of India for insurance companies, PFRDA, EPFO for NPS and pension funds are very important in terms of our engagement and policy making with them, so that allocation of capital from these three institutional domestic investors could actually come into the asset class and propel it forward. Along with this, being the third largest ecosystem, we played a pioneering role in engaging with Invest India, Startup India, DPIT, Niti Aayog, SIDBI to mobilize the FFS program and do whatever it takes in terms of policy making for getting more startups to get incubated in this country and help the economy grow. Moving on, we wanted to highlight certain significant wins that IVCA has had recently in terms of our advocacy engagement. So over the past FY or so, we've done about, from a engagement point of view with the regulators that we've highlighted, about 47 plus representation, which is just before the budget in this FY. And from this kind of an engagement, and the ministries went done right to the FM level in terms of engagement with them before the budget. And what we came out with in terms of budget was wins on the so the biggest few wins which I can highlight here are the abolition of the angel tax. IVCA over the past many years had been advocating abolition of the angel tax right when it was initiated for all investors in startups, and then post that when it was initiated. Excuse me, just one second. Yeah, sorry for that. So we had been advocating angel tax abolition right from the last many years. Recently, also when it was reintroduced for foreign investors, our engagement deep into the Ministry of Finance, right into with the Department of Economic Affairs as well, entailed that we informed them that FDI inflows will also be impacted because of this, and our ask was to actually include Singapore, Netherlands, Mauritius as key countries in the exemption list, and apart from that, reducing the investor pool for funds from 50, which was mentioned in the exemption, to about 20, so that the alternative investment funds could also be exempted from the angel tax ambit. But then it was a very welcome move that in this budget, the entire abolition of the angel tax had happened. And Yeah. On the capital gains front, since last 6 to 7 years, we had been advocating about rationalization of the capital gains. Investors on the unlisted side who take enormous amount of risk in incubating startups and mature companies, they provide long-term sticky capital to incubate these companies and take risk much more than probably public market investors. They should at least be at par in terms of taxation, in terms of investments. So from that perspective, this was a long-standing ask, which actually was answered by, and from a parity point of view, rationalization was done in this budget, which is a very welcome move. And we thank the Government of India, Ministry of Finance, or Honorable Finance Minister for the same. Aside to this, some of the notable introductions was that a sector-focused, government's focus now over the past 3-4 budget has been on introducing sector-focused government-sponsored fund of funds. This year, they introduced that there will be 1,000 crore corpus as part of a venture capital fund, which will mobilize capital into the space economy. This is one of our long-standing asks, as well as our continuous engagement with Department of Economic Affairs to make them understand how to bring in private institutional capital into the FOF form in a blended finance fashion by government sponsoring it. So this is also one of the biggest wins along with the other two. On the IFSCA, we've been working very closely with IFSC authority as well as the Government of India in order to create IFSC as a fund management hub and make it very attractive for fund management entities to register and operate from there. With the introduction of variable company structure, which is prevalent in Singapore and gives comfort to private equity and VC funds globally, has been introduced now at IFSCA. And from a distinct funds point of view, in one single entity, various funds could be structured. From an operational efficiency point of view, this gives a lot of comfort to foreign investors and other funds as well. So this is a very welcome move. Aside to this, Section 68 deals with unexplained cash credits. Under the Section 10(4)(d), which looks at specified funds, now inclusion of FMEs also in this section enables that from an operational ease point of view, there won't be any explanation or documentation that need to be given since the FMEs would be exempted now. From a SEBI perspective, erstwhile venture capital funds and AIFs whose tenure was ending or had unliquidated assets, there was a lot of pain in the industry in terms of how do we actually deal with such investments. And from that perspective, our engagement with SEBI, we could get certain relaxation in terms of provision through a circular wherein VCFs could migrate into AIF category 1 as migrated VCFs. And on the unliquidated investment side, liquidation scheme, because of the lack of tax neutrality, was giving an issue. So SEBI could actually understand that through our engagement. And we, instead of liquidation scheme, got a dissolution period. And it was also a welcome move to relax the concerns that the funds had with the liquidation scheme. With Department of Economic Affairs, again, a lot of concern in the industry because of non-recognition of partly paid units in a circular through RBI. And through our 2.5 year long engagement, what could happen was that we could actually get this exemption in a recent circular. And now that the partly paid units will be recognized, penalties actually will not have to be paid. And this is a much more, better move in terms of relaxation for the industry. On the RBI front, everybody knows about the December 19 circular, which restricted the regulated entities into for investing into AIFs, who in turn had portfolio companies who had an exposure to these regulated entities. On that, again, we engaged with the very senior stakeholders at RBI. And what could happen was that at least with the March 27 follow-on circular, we could at least get relaxation in terms of the exemption given to AIFs, regulated entities who will be investing in AIFs who through equity shares, like where AIFs are investing into portfolio companies through equity shares. So that was one. And from a provisioning point of view for banks, pro rata provisioning is also something that came into that circular. So because of these, we had certain relaxations from the erstwhile December 19 circular. But at the same time, there are certain hurdles which Sonia will also allude to in the next slide, which we are engaging on and we'll update the industry about. On the IFSCA front, a recent SEBI circular expanded the contributions of NRIs and OCIs from 50% to 100% into FMEs, and this will make it much more attractive, because that was also a long-standing ask to increase the participation of NRIs and OCIs into funds. So this is also a very welcome move from SEBI's perspective. Moving on, I'll hand it over to Sonia to give updates on some critical engagements with certain regulatory stakeholders.
Sure. Thanks, Rohan. Thank you, everyone. Good afternoon, everyone. Thank you for joining us today. Hi, all. I am Sonia from the advocacy team at IVCA. And it's my pleasure to welcome each one of you for this regulatory update webinar. I will start by providing an update on the GST matter. We understand the growing concern regarding the GST notices. We acknowledge the same. IVCA have been working on the particular GST matter from the several years, especially after the eConnect case. We have been actively working on this issue. Over the past 6-7 months, with the support of the Regulatory Affair Committee co-chairs, members, representatives, knowledge partners, we have been consistently engaging with CBIC and MOF officials for this particular issue. Multiple meetings have been held in this interval, including meeting with Revenue Secretary, Joint Secretary of CBIC, their team, the team of CBIC. The DGGST team visited IVC office to understand the operations of AIFs, as in how does it work. The CBIC and DGGST team then met SEBI to better understand SEBI regulations and functioning of AIF. CBIC also organized a combined meeting where they invited IVCA members and officials from SEBI, CBDT, TRU, DGGST. We also met Joint Secretary of TPRU. So there have been, multiple interactions, multiple meetings on this matter. IVCA is advocating for two key issues. One, the non-requirement for AIFs to register for GST with CBIC. A long debate discussions have happened in these meetings where, where the officials have raised concern that AIFs should take GST registration and then they can claim input tax credit. We clarify that AIFs are merely a pooling vehicle and do not render any services. They should not be subject to GST registration. Also, we highlighted that taking GST registration would violate the SEBI AIF regulations as well as the tax pass-through status that has been given under the Income Tax Act. They were also willing to understand and comparing it with the mutual fund, that if mutual fund can take GST registration, why not AIFs? We made them understand the nature of the business operations of a mutual fund and how it is different from AIF. So while IVCA continue its efforts to clarify this matter, we are engaging, we are trying every best to engage with them. We request all our members to refer our submissions, especially the operating manual, which is being uploaded on the DocSend, so that, to ensure that industry speaks with one voice in their responses to the department. The second issue, is the clarity on the treatment of the carried interest. Again, in these meetings, we had these discussions with them. We have requested for the clarification that it should be continued to consider as a capital gain and should not be subject to GST. We are preparing strong arguments. We are pushing this issue. We are trying to push this issue with the highest leadership. But like I said, we continue to advocate, for the clarity. We will keep our members updated on any further development which happens in this particular matter. And, till that time, we just request that you can refer to our submissions for all your responses. Rahul, would you like to add? Yeah,
sure. Thanks, Sonia. So good afternoon, everyone. This is Rahul here. IVC does acknowledge that GST is an issue which is troubling across board the entire AIF industry, whichever strategy you are, and even to some of the global players, this is a burning issue. So we acknowledge, and I think IVC is on top of it. Over the last 6 months, a lot of extension has been given in government meeting at the most highest level, is that we have engaged it. We have involved quite a few experts, large experts, whether it's Deloitte, KPMG, EY, PwC, all of us are members and knowledge partners. And we are leveraging their knowledge, their relationships within the government also to give us the right solution. Having said so, quite a few members have reached out to us with a concern of notice being received. Let me tell you that from what I understand, it's not possible for IVC or anyone to stop the notices. There is a time barring period which has happened. No government bureaucrat cannot issue a notice, and therefore that may lead to a CVC issue on vigilance on issue on himself. Having said so, my suggestion and request to every member is to take consultation of their experts and respond to that notice that they've received according for every question they have raised. The answers to questions could be, as far as possible, try to be the same that IVCA is using it, and given the rationale in the various documentation, which we have been sharing frequently by emails. It's on the doc send. So try to maintain that similar rationality across various questions raised to you. But let me assure you, this issue has been taken on at the highest level. As Sonia even mentioned, we were trying to escalate even to the government leadership as to go at the highest level. And we are issued, it's not just a question of GST, it's also the taxation of how carried interest to be considered, whether it'll remain as a carried interest, whether it's capital gains, whether it's professional fees also being taken up by IVCA at the appropriate level, and the impact of this, if it was not considered capital gains, it would have on the entire VCP industry. And onshoring the offshore fund is the question that we are taking up with the government. But I think it'll a battle which all of us have to just run through and just be patient. And IVCA is on top of it at the most. That's what I like to tell the industry. Sonia, carry on.
Yeah, thanks. So yeah, in terms of RBI, the two important issues that that is ongoing with RBI is one, the 27th March circular, like Rohan has already highlighted. The December 19th circular restricted RBI regulated entities their ability to invest in AIFs, but we got few exemptions out of that. However, in March 27th circular, still the equity linked instruments such as CCPS and CCDS are not included. We advocated, this concern with RBI. We met the RBI officials. We made the submission and we requested for the clarity through FAQs that CCPS and CCDS should be included into it. However, the current stance of RBI was very clear that they have kept this equity linked instruments out of the purview of circular. In terms of overseas investment limits for AIFs, again, the RBI acknowledges the rationale and the industry perspective that the limit should be increased. It's very minimal. However, due to the geopolitical risk or the need to protect the currency, their current stand as of now is that they are not inclined to increase the ODI limit. Having said so, we continue our efforts with RBI and as well as the ministry. These two issues are on the top of agenda. Whenever we are having any meeting or discussion, we try to bring this issue again and we try to request for the clarification on both the issues. In terms of domestic pools of capital, it's one of the key charter of IVCA is to mobilize the domestic pools of capital in India. We have been consistently advocating for channelizing the large amount of patient capital from the domestic institutions such as insurance companies, pension funds, EPFO, PFRDA, charitable endowments into AIFs. Through these interactions, in these past years, what we have understood is that there's a regulatory gap in understanding this asset class and the benefits. We are actively engaging with DA, ADA, PFRDA, DPIIT, HCIM, NITI Aayog, LIC. Our goal is to raise the awareness about the importance of this industry and the value this asset class can deliver. Our recommendation also includes promotion of the fund of fund structure, because of which there was an introduction of blended finance model in budget 22-23 by finance minister. However, nothing has happened after that. But again, our request to DA, our request to finance minister is to operationalize that fund of fund structure. IVCA has also formed a capacity building working group, which is being formed with the focus to, build the domestic capital pools in India. So the current IVC leadership is committed to working with the regulators to build this, build the capacity building and boost the domestic capital allocation. This is what, is ongoing. And Rohan, would you like to update everyone on the key engagements with SEBI?
Absolutely. Thank you, Sonia. We would like to, so the latest move from SEBI's point of view was the proposed new asset class under the mutual fund regulations. Now, we've met up with the senior stakeholders at SEBI as an industry body, along with certain representatives of a working group. And the understanding that we got from SEBI was that they're very comfortable with the construct of a mutual fund. And from a governance perspective, it's non-negotiable that it is going to come under the mutual fund regulations itself. That's something that they've conveyed to us. Although they understand through a rationale that we gave to them was that it is important because the strategies that might come under the new asset class, for AI fund managers would be better adept in, because they have had a decade of experience in managing such strategies. There should be a level playing field, and these fund managers should be allowed to be eligible to operate this new asset class. There have been submissions made. We've met up with the senior stakeholders. They've understood our rationale, and we are closely working with the specific team which is looking at formation of this new asset class to make them understand why this needs to be done. And we'll soon keep the industry updated as soon as we have an update from SEBI on the same. From a Cat 3 tax clarity point of view, AIF Cat 1 and Cat 2 pass-through was an instrumental move, which was also an advocacy effort of IVCA long back. We had been fighting to get pass-through status for Cat 3 funds as well. And in one of the interactions, we could understand that maybe for long-only funds, we could actually get Cat 3 pass-through. And that's why the Cat 3 Council at IVCA decided that a way to address this would be to subcategorize funds, as 70% of the funds registered with SEBI in Cat 3 category are long-only funds. So we made a proposal to SEBI to subcategorize fund into long-only, long-short, multi-AMC and all. And that proposal is being examined by SEBI. And if that happens, maybe there is a way that we found out to get pass-through for long-only. Plus, there are certain concerns that domestic institutional investors have in investing in alternatives like price discovery, daily NAV and all. And Cat 3 funds actually address those solutions. So maybe on the long short side, some DIIs could be interested in investing if this subcategorization goes through. So this is a very important move, and we are closely working with SEBI on the same. On the NISM certificate, yes, it has been mandated by SEBI for all the fund managers. So in terms of one key personnel from the investment team to get this certificate, the relaxation that we've sought from SEBI is that if at all an undertaking can be given at the time of registration of the PPM documents with SEBI, that before the launch of the scheme, the certificate can be obtained. So this is something that we are working with SEBI. A relaxation may come, and we'll keep the industry updated on the same. At the same time, the feedback from the industry, those managers who had taken this exam, was that the exam is commingled, in the sense that Cat 1, 2 as well as 3 questions on these strategies are there as part of one exam, and it would be better placed if we can actually segregate into 2 modules, which we've actually highlighted to senior stakeholders in SEBI. They've taken a cognizance of the fact, and as soon as there is an update, we'll keep you updated on the same. There's also a development of a CPE classroom program which has been done by NISM, because we also engage with them on these tests. That has been developed, and NISM also is waiting for a nod from SEBI to go ahead and launch that, so that without the test, fund managers who are interested to take this certificate can actually attend a one-day classroom program and take the certificate, and also take the same for renewals as well. Moving on to the SSF. Last regulatory webinar, we had briefed you about the construct of the SSF. This stands for Standard Setting Forum for AIFs. IVCA acts as the secretariat for the SSF to balance the regulatory objectives as well as the industry, ease of fund management in the country. And from that perspective, there are many things on which SSF has been working since its inception, end of last year. And we've highlighted some of these, for your reference. So all of you might be aware that SEBI came out with a circular wherein they specified circumventions that they were observing that were happening through the IF structures. This was of grave concern, and we engaged with SEBI to try and understand how this could be alleviated. So the SSF has recently submitted a checklist to SEBI on the request of SEBI itself, that do's and don'ts in terms of specific circumventions highlighted by SEBI on QIB norms, FEMA, as well as evergreening of loans, so that at least like a large portion of industry which is doing things right can actually benefit and move ahead in terms of compliance. On credit of AIF units, we had engaged with the industry to try and understand their concern or investors not giving their DMAT details, and SSF actually put in the implementation standards so that an aggregate escrow account could be open for credit of those units for which investor details are not there, DMAT details are not there. Standardization of the PPM audit report, standardization of the format for reporting to custodians by AIFs. These are 2 things on which SSF worked. Then on the operational guidelines in terms of borrowing, so there are 2 pieces on which the SSF worked. One was SEBI said that leverage encumbrances could be created by pledging shares of portfolio companies in the infra sector by AIFs who have invested in those companies. On this, implementation standards were formulated by SSF, and then they submitted it, and a circular came out. A recent circular highlighting how borrowing could be done in terms, short-term borrowing by AIF 1 and 2 was also a submission by SSF, in which we highlighted the concern that when capital calls get delayed from LPs to meet the short-term, capital requirement, borrowing could be done by Category 1 and Category 2 AIFs, and that's something that, as part of the circular, SEBI has recently introduced. Aside to this, there were certain amendments that were done in the PPM which should not constitute as PPM amendments, which are minor in nature. So on that, there is an exhaustive list of the such PPM amendments that were shared by SSF to SEBI to make it easy in terms of compliance for fund managers. Aside to this, which are the instances which would qualify as material adverse effect for exclusion is something that also was submitted by SSF to SEBI. So, a whole lot of work gets done by the SSF, and the primary objective for the SSF is to balance the burden in terms of compliance on the industry for operationalizing the circulars that SEBI comes out, as well as the regulatory objective that SEBI has through these circulars. So this was, the update in terms of the principal regulator. Moving on in terms of certain ongoing issues which probably are critical, but there is work going on with SEBI on the same. As I've highlighted certain, bold ones. From a Cat 3 perspective, since there is, from a taxation point of view, disincentive as well, the industry has to grow, but it's not growing the way it could. So there are certain things that we could work on. So exchange leverage, increase in that is something that we've engaged with SEBI on recently. They have taken cognizance of the fact. And there's work going on almost every day to explain to them how exposure could be created, how a scientific calculation of volatility could be done. And if something happens on this front, which we are positive on, it will really benefit the Cat 3 funds. Some of the funds, even now on the Cat 3 side itself, 1,000 investor limit is something that gets breached. It's a number which was set, when the AIF regulations were initiated. But now, just because the number is reached, funds have to open up another scheme with us in the same strategy itself. So we've highlighted this to SEBI. They are okay increasing the number, and we have to just rationalize and specify a higher number to them, which meets the privately pooled placement vehicle criteria as well, and at the same time reduces the compliance burden for funds. LVF is something on which 70 crore was the threshold, but we have asked SEBI, and they are examining our proposal to reduce it to 10 crore. There are around 28, 29 LVFs that have been registered, but it could be much more. And there are domestic institutional investors also who are willing to put in money, but because of this threshold of 70 crore are not able to come into an LVF, but they would prefer to come. So that's why, and PMS accredited investor has a 10 crore threshold. So there is anyways an arbitrage that's happening. So we've highlighted this to SEBI. They are examining it, and if there is an update, we'll highlight it to you. On the FPI front, additional disclosures to custodians have created a lot of problem. On that also, we are engaging with SEBI to try and understand how concerns could be alleviated here. And such disclosures, if at all they are not necessary, some of the FPIs could come out of the ambit of such disclosures. Accreditation process also, the investors have not taken the process fully, purely because it needs to simplify further. And documentation also, the number of documents that need to be submitted need to be reduced. Maybe there is a way in terms of KYC agencies doing this accreditation for investors, and a longer certificate in terms of duration could also be given to investors at a lower cost. So a working group actually is working to simplify this, and we are working closely with SEBI to try and get more AIs into the system. So that's one. On this, the regulation 17A of SEBI, a lot of credit funds were facing problem because of the change in LODR regulation, where the debt securities had to be listed. So purely to address this concern in Cat 2 funds, where it says that these funds need to primarily invest in unlisted securities, they are trying to expand this definition to include such debt securities also, so that credit funds who are facing problem of listing of debt securities do not have a problem, and they can easily comply. Aside to this, on valuation, there is a lot of concern in terms of confusion in the industry. But all of you might have received the IPEV guidance note that IVCA has created, and it is a clear recommendation by IVCA that on the mutual fund side, the regulations will apply to listed securities which are traded as well as above investment grade debt. And for the unlisted securities plus below investment grade securities and thinly traded listed securities also, IPEV guidance framework should be applied. SEBI has taken cognizance of this fact, but at the same time, we are awaiting a circular or some clarification from SEBI so that industry could actually get away from this confusion. Aside to this, we are working on, AIF tranching, which is also priority distribution, was kept on hold because of evergreening issues that SEBI had identified. But our engagement with the ministry on the blended finance front, wherein the government could come in into a junior tranche to mobilize private institutional capital coming into this sunrise sectors, is something that the ministry also took cognizance of, and SEBI has recently internally approved of it, that such a structure could be allowed. But they are now examining how pro rata rights as well as pari passu rights of investors could be standardized in a way that such structures could be allowed now. There is an investor charter also on which we are working. So there are many of these issues on which there is work going on, and we'll keep the industry updated on a regular basis on this. Moving on, I would like Sonia to highlight some of the ongoing work with other regulators.
Yeah, so like Rohan said that Rohan has already updated on the SEBI one, but I'll start with the DA. So whenever any issue arises, we often find ourselves reaching out to the multiple departments and almost all. To streamline this process, we have requested DA, for a single point of a contact, a senior official who could specifically look into the industry issues, whom we can reach out to them and, would help us to resolve the concerns effectively. We have also requested the finance minister and DEA for rolling out the Damodaran committee report. What we have understood is that this report is within the industry, within the ministry, and industry has no access to it as of now. So we have requested for that. With DPIIT and with the recent buzz around the press note 3, we have submitted our proposal on the green channel and a well-defined timeline approval. Along with this, our long-going ask in, like change in the definition of the startups, the ESOP proposal is already going with DPIIT. With CCI, we have, started engaging with them, and we are also planning an orientation session for the CCI officials to basically make them understand how does the asset class work, how are the deals happen, mergers, amalgamations, etc. The discussions are ongoing. We are trying and we are interacting with them. We have also submitted our representation on change in the definition required for the minority acquisition exemption, which is being provided by the CCI. We have also requested finance minister to look into it. In terms of the tax issue, we as we all know that there were few wins that have happened in the post the budget, but few issues that we are still asking them is one, section 50 AA, that impacts the long-term investments in unlisted debenture by Souvenir Wealth Fund. We request an amendment to section 1023 FE to ensure that these investments retain their indented tax benefits. We have also requested, exemption of AIS from the TCS provision. Then again, tax treatment of AIFs in security, who invest in security receipts, and SSF invest in stress loan. We have been requesting for a pass-through status from a very long time. We had a discussion with DFS and DA as well. We have also requested for a classification of the securities held by Cat 1 and Cat 2 AIFs as capital assets, so to attract the capital gain treatment. In terms of Cat 3 taxation, again, a very long-term ask that we have been requesting, the CBDT, the ministry, to look into it for the clarity. Over the next slide, so these are the few ongoing issues, and apart from this, there's a next slide where all the additional issues are covered. Rohan, if you can go to that next slide, where, a combination of 60 to 70 submissions that we have made to the government. All these issues were part of our pre-budget submission, have been discussed in with few intervals with the different departments. Few of them are highlighted. With IFSCA, our discussions are going on. We have been requesting for the outbound fund tax regime in IFSCA, a special tax regime for the outbound investments. We have been requesting for grandfathering treaty or, relief for capital gain on sale of security, exclusion of offshore funds, AIF, business trust, securitization trust from the definition of the specified mutual funds under Section 50AA. So these are, ongoing, issues that we are working on and interacting with government on the regular basis. Now, I would like to hand over this to Rahul to take us all through the next step and, the next action that we have planned. Just to update you all these submissions are uploaded on the DocSend. So if you want details, you can have access, you can see it from the DocSend. Thank you. Rahul, you are on mute.
Yeah, thanks, Sonia. Again, I think the last few slides we have presented as to what we have done over the last few 6-8 months or a year or so. What have been the wins? Now we also at the same time keep on thinking of what's ahead. We also have a regular affairs council who guides us on the matter, and a few critical items. A part of the item is Rohan and Sonia has covered in the earlier slides. There are more macro issues that we like to cover over the next 1 or 2 years. The most critical issue, as we have mentioned, is of the taxation of the AIF industry. The catalyst has been the Econet case and how the GST on carry is coming up to be, and the various notices that the AIFs have received. So that is on top of our agenda to engage with the government at all levels, both technically from impact perspective, and to present to them as to the impact it can have and address the issue of direct taxes, which could lead to on capital gains tax on carry, on indirect taxes for GST, and not to have notice, ask for registration, because this is a pooled vehicle. Finally, AIF doesn't provide a service. The government departments have their own view, which I'm not kicking up on this call, but they have their own perspectives. We are addressing those perspectives, and discussions are on. But our whole idea is to present that it's on top of our agenda. It's a very critical item for us, and it is going to remain the critical item for the entire regular affairs team of us at IVCA. The next big thing is the whole purpose of IVCA is to sort of catalyze domestic pools of capital. So apart from insurance funds, pension, EPOF, even the RBI circular of CPS is a hurdle that we have to address. It's not been an easy battle with RBI. They have their own views again on CPS. They have taken a conscious decision of why they have excluded them from the March circular. But our efforts are on. It's not that we are giving it up. Just like the angel tax or the tax parity, which took almost 6-7 years, I think IVCA doesn't give up just with one submission. We just keep on persevering, and hopefully be able to convince them and the government that there's an impact on the entire industry, and they will take up the RBI issue. And even the ODI, again, ODI is a big issue because the limit is stuff at this stage of $1.5 billion. Discussions keep on happening at the RBI level and at DFS also at the center. The reason to expand this limit. So efforts are on. The third critical is the Damodaran committee. I think we worked on it almost 2 years back. Committee report came up, and we've been told it's lying in the government. The government senior bureaucrats say they are reviewing it, and we are pushing it for it to make it public, first of all, because it's not officially shared with anybody else, and to take up the various submissions or the recommendations of the Damodaran committee should be taken up for the AIF industry. Now, this also linked to the next two items. We all know the AIF regulations came up in 2012, and it has been a great growth for the entire industry. But it's now almost 12 years old, and this has been a discussion within AIF, and many members have come and told us also we've taken up the IPAC to maybe look at the entire AIF code from a new perspective. And review of the AIF code is one more thing which can happen this year. The Regular Affairs Committee is going to work with SEBI and to see a much more whichever changes are required. A discussion is going to be had with SEBI on preparing a new AIF code. It's just the beginning at this stage. There is no timelines. But idea is to work over the next 6 to 8 months or 1 year on this. The next is if you heard the finance minister also mentioning about the new tax code that they're talking about. And here also IVCA and along with the Regular Affairs Committee would like to engage with the government to see that some of the things that I've been asking for, an AIF code for Cat 1, Cat 2 can be a separate thing we create up. And therefore all the confusions and notice that the industry receives going forward can be sorted out at the very beginning of the tax code itself. And here itself, the entire taxation of carry can be addressed both for CBIs and CBDT is what is our current objective. And this is another critical item that you're going to work on. And in that, again, comes the Cat 3 pass-through. We have been working on it for the last few years. So whether new tax code happens or not, Cat 3 pass-through is a critical thing that we are engaging with, as Rohan mentioned, with SEBI, to subcategorize this segment into long short, and sort of give more clarity to the industry. And that way the CBD also gets much more comfort and maybe consider giving tax pass-through for some portion of Cat 3, which is the long-only funds. So there are 6-7 items which are really focusing going forward. However, that does not mean all the earlier issues that we have mentioned about 60-70 issues that we have, which is not critical. Or I'm just trying to bring up the main 6-7 items that we are going to focus at a very macro level. So, and to that, again, I would like to end that, IVCA communicates to all its members of all the submissions done, and the process. There's a continuous emails going on many times, especially for example on GST or on dematerialization or valuation. We've been sending emails, communication for a part of each of our submissions or on DocSend. So any member can access this subject-wise, area-wise. All our submissions are available. And people, however, we don't allow downloading because we don't want to be shared with anybody else. But the gist of the data is available. The reasoning is available, and that can be used by the or seen or reviewed by the member concerned and take it up from their perspective. We also have monthly capital calls where all submissions and meetings that the IVCA has been holding is also generally fully exhaustively covered over there. To that, I think I'm almost coming to an end of our submission. And at this stage, I really would like to thank all our members, our Executive Council members, our various council, Credit Council, Credit 3, Regular Office Council. All our members have been very sort of supportive of IVCA. Whenever they, we are called upon to have the meetings, they, along with the normal business that they do give time to us, travel to Delhi, maybe anywhere, then meet the ministry within 24-hour notice. So really thank all the members. I thank all the Executive Council and the Regular Office Council, and more importantly, all these the knowledge partners. They have been really toiled them quite a bit, turning the timelines that we give them to turn around submissions really short. But they've been up to it and really support us with all the ideas and submitting. And again, they are also available for meetings whenever required at the ministry and even on holiday. So I would thank the entire support system over here, without which IVCA cannot do what's doing just now, okay, and achieve its results. So thank everybody on this entire process. And if anybody has any questions, you can put them in the Q&A, which Sonia can take it up. But even if you don't have questions today, please write to us at advocacy@ivca.in, and we'll address those questions, or call me, Rohan, or Sonia anytime, and see we can address your queries or any concerns that you may have. Thank you, everyone. Sonia, over to you for the questions.
Yeah, thank you. So there's one question on NISM certificate holder. Can it be an investment team member whose name is not listed in the PPM? Yeah.
Rahul, you want to take this? My interpretation of the circular is that it specifically mentions one key managerial person, and from a KMP perspective, folks are mentioned in the PPM. So fund managers can defer to their legal advisors in terms of interpreting the circular. But our interpretation is that this should not be the case. One KMP needs to take the certificate. Rahul, over to you.
Yeah, I agree with I think that new person can do in the new subsequent years, but I think for the old AIFs, if they have to comply with, they'll have to comply with what was mentioned in the earlier PPM of that AIF. It's my conservative view. I don't think if you only go to SEBI, will take a liberal view. They will stick to the letter of the law and not just the spirit at the stage. That's my view. So, and as I take your legal advice and move forward, the best case over here.
Sure, thank you. The another question is about NAC. Will an AIF manager has to apply for full-fledged MF license or managing scheme under NAC? Is there a little route or talks around the same?
Okay. So the first primary thing that SEBI has conveyed to us is that compared to AIFs, they are very comfortable in terms of the construct, in terms of regulation, governance, compliance standards of mutual funds. And because of that comfort, it is going to come under the mutual fund regulations itself. Now, whether there will be a relaxed eligibility criteria to obtain the MF license is something that we'll have to wait for from a SEBI perspective to define. But at the same time, as an industry, we are asking that on two pieces. One part is on the AIF manager being eligible to operate the NSE. There should be a level playing field, which we have proposed. But at the same time, for these AIF fund managers to obtain the MF license also, there should be some sort of a way which is a little relaxed than already erstwhile mutual fund license holders. Rahul, you want to add your perspectives in this?
Yeah, so see, as per the current consultancy paper just come on the table, it's going to be a full-fledged license. So as I said, we have had discussions with SEBI. The working group has reached out to them and told them it has to be a level playing field. And therefore, this class, new asset class, should not be restricted only to mutual fund players. The entire industry, whoever has competence to manage this kind of asset capital or this kind of fund should be allowed to be entered. I think SEBI has acknowledged in that sense that it should be a level playing field. It's a fair ask. And therefore, to that extent, SEBI has requested IVCA to come back with what should be the objective criteria be to be allowed, and from what is otherwise mentioned in the consultancy paper. So as we speak, the working group has come up, have decided on the criteria. We are submitting, and the knowledge partner is preparing the final draft. In a day or two, the submission will be done to SEBI as to what is IVC or our industry's perspective, what the entry criteria should be. And we are drafting it in a manner is such that we sort of respect SEBI's concerns of supervision of MF, and it's a retail money finally. So we have to keep that in mind. At the same time, to see that some of the AIF managers are able to play a role over here. So we're trying to marry the two, the objectives and making a submission. We finally have to see whether what the final rule is. So today, nobody can say whether the manager can apply or not till it really becomes a regulation. Today, it's just a consultancy paper. So I'll have to wait and watch. And we are hopeful that SEBI makes it a level playing field for all fund managers in the country, not just restrict to only the mutual fund players. It's our hope over here. And I think SEBI also realizes that it should be a fair play for everybody. But as they want, the supervision of mutual fund regulations are much stricter. And this being a little more retail play, they feel it's better to be on the MF regulations and not a separate regulation of a separate class.
Yeah. And for the folks in the audience, we also want to highlight one perspective because it's important for you to know. So SEBI has not come out with this proposal to cannibalize any other segment's market. They want to specifically address the segment of retail investors who are willing to take a little higher amount of risk by giving them a professional setup to do so. So purely it needs to fit in between the MF, PMS and AIF categories. And that is why they've given comfort to us that when they're drafting the regulation, they will see to it that cannibalization of the AIF or PMS market does not happen by introducing this asset class. Sonia, over to the next questions.
Yeah. Again, there's a question for SEBI. What does SEBI says on IPV guidelines acceptance for AIFs?
So again, on the valuation piece, that's Atri. So on the valuation piece, we are still awaiting more clarity from SEBI. But what has come out is that the IPV guidance framework, which according to the circular had to be issued by the largest representative association, was done so by IVCA. It was done in consultation with most reputed valuers who are doing valuation for portfolio companies of AIF fund managers in India. And that IPV framework needs to be used by AIF fund managers to comply with the circular. Now, when it comes to the confusion, most of the folks who've been calling us, the confusion is with regards to the 3.1 clause of the circular, wherein on which instruments MF regulations should apply in terms of valuation and on which IPV guidance framework should apply. So we, through the engagement through these independent valuers, our proposal to SEBI, which we have updated to fund managers, also has been, as I stated in the presentation, is that for listed securities which are traded, plus for above investment grade debt, mutual fund regulations need to be applied. And for listed securities which are thinly traded and below investment grade debt, plus at the same time unlisted securities, IPV guidance framework should apply. So this is very clear in our purview, and this is what we've recommended to SEBI. They have understood our rationale, but we are waiting from a clarificatory circular from SEBI on the same. Rahul, you want to add more to this?
No, perfect. I think
okay.
I think if you look at our our guidance note along with the IPV, it clarifies all this, but yeah, the final clarity is not has been expected from SEBI. Our submission meetings have been done with SEBI, and to some degree that ball is on SEBI's court. And as usual, IVCA just keeps on persevering, keeps on reminding them to be, ask for clarity from us if they need something, or provide a circular to the industry, and we are waiting that.
Sure. Sonia,
two
there were two questions on PN3 which were earlier.
I'm just discovering that that's the same question, that in context of PN3, is there a clarity for onboarding of investors from Hong Kong, Taiwan, which falls in a unique geography?
Yeah, I don't think so. I don't think we have the government has in the PN3 given any such clarity in black and white. I think it's every time an application is made, I think the AIF or the investor and the fund will have to make an application to government, face the questions over there, and it's a case by case scenario where the government talks about. What we have asked as IVCA is that if a particular fund is cleared for a X transaction, then subsequent transactions do not ask for because that same fund is investing in different places. So it's cleared from a PN3 perspective. So if an entity is cleared from a PN3, it should get a green card or green channel. And therefore, then the same fund may not disclose all its stakeholders or the investors, and that information will be asked, and that sort of green channel we are talking about. But we are not saying that the PN3 should be removed or some country should be removed from the government. It's a case-to-case basis which you'll have to go through and ask for approvals from the government as of today. And even going forward, we are not asking any country-wise exemption. We are asking for a fund level. If an exemption is achieved in a particular transactions, then the government has all the data of that fund. And then for subsequent transactions, there should be a green channel for that transaction, is what I ask at this stage with the government is. And to make a process more timelines indicated, because they are currently it's open-ended, we hear a lot of delays. So again, we request the government to give some timelines within which the process should get, an application should get cleared. That's what our suggestion is.
Thanks. One question, Rohan, if you want to take this, could you please repeat the FAQs with respect to CCDs and CCPs for the RBI circular?
Yeah, sure. So FAQ has not come out from RBI. Once the March 27 circular came out addressing the concerns that we had on the December 19 circular, we engaged with RBI that RBI issues an FAQ which addresses that by equity shares they would mean equity linked instruments, so that CCPS and CDCS, which are not covered specifically in the March 27 circular, there is clarification for the industry that if they are issuing, doing deals based on CCPS and CDS, those AIFs also can raise money from regulated entities, which would be, of RBI. So that is the FAQ that we are talking about. But we would also like to highlight that RBI has clearly conveyed it to us that it was not an inadvertent mistake, or they probably didn't recognize equity linked instruments. They intended for it to be equity shares, and that is what they've given in the circular. So as of now, we are engaging to get some relaxations, but at the same time, like from RBI, they have clearly conveyed this perspective to us that equity shares is something that was meant to be in the 27 March circular, and as of now, they are not issuing any FAQ as of now. So that's the FAQ that we talked about.
Thanks. Thank you. There's another question for GIFT AIF. Round tripping is checked at fund level or at scheme level?
Sure. So we'll have to check with some of the tax consultants there. Since we are association and we do not manage funds as of now, from an operational point of view, some of these issues related to operational management of funds, we would not be able to ascertain. Many of the folks have not highlighted who are FMEs at IFSC have not highlighted something like this to us. But we'll take a note of this, and it would be great if you could also write to advocacy@ivca.in so that we take cognizance of this and we can respond to you after engaging with some of the advisors.
No, let me also point out, both Rohan, me and Sonia are not technical experts on the subject. And each of these items require technical evaluation, past case laws. So it's best that you engage with your experts, consultants, legal view, and go forward with your action plan. That's what I said about the GST notices. Now, we are just a platform to engage with the government, take with a view, come back with, but technical interpretations will be left to the experts at large. Even today, it is the technical experts who guide us for making every submission to be made, whether it's lawyers or chartered accountants, and interpret the law.
Thanks. Any talk around minimum investors, QIB participation by single investors in AIF scheme in line with what consultation paper released last year?
So Rahul, you want to address? The only point I can make is that as part of specified circumventions of SEBI, violation of QIB norms was happening, and SFA has done a discussion and contemplated as to, from a risk perspective, if there are funds which are concentrated single investor funds, but there is a need of the hour in terms of those structures, and they may not be necessarily violating any QIB norms. How do we address and balance the objective that SEBI has in terms of avoiding, circumvention of these norms through the AIF structure, but at the same time balance the need of such structures in the AIF space. So that's what SFA has worked on, and we are still engaging with SEBI to try and understand how these could be addressed. But Rahul, over to you.
On the minimum quantum, I think there is discussion within SEBI, and off and on those discussions come up with us to increase the minimum threshold of AIF. As of date, IVCA has been able to sort of convince SEBI to hold on to it, and we are focusing on them to sort of ease the process of the accredited investor. And that should be the target, that to create accredited investor more easier, reduce the cost of doing accreditation, remove the paperwork. And if the accreditation investor population increases, AIF and we are sort of telling SEBI to move that only accredited investors should invest in AIF. And therefore, if that happens, there should be no minimum threshold at all. That is the objective. SEBI, I'm not saying SEBI is also has the same view, but and having said so, let me tell you, we hear the Damodaran committee, the expert committee has indicated the minimum threshold to be 5 crores. We as IVCA, we don't have that figure officially. This figure has been told to us by SEBI themselves. The government committee itself, as one of the recommendations, said it, and you want to implement that, and they are trying to implement that recommendation. So we are trying to say, go by the AI process, make it more easier, and make it no threshold for AIFs if for an AI. Those are discussions, sir. There is no laid down timeline on this. As I think we mentioned, Rohan mentioned in the call, the working group of AI is working on the same situation with SEBI, but minimum threshold is a sword hanging, and yeah, SEBI wants to increase it. And while they've done it to a PMS, from 25 ka 50 kiya hai, so they are saying if they are doing it, why not this class? As of now, IVC is able to hold on to that, cannot increase at the moment. That's all I can say.
Thanks.
Yeah, I just wanted to highlight, Sonia, we're already at 5, and I've read through the questions. Most of them are technical in nature now. So maybe you can skim through, and then maybe we can just ask the folks to write to us on advocacy@ivca.in.
Sure. I think we can just take this question that there is no clarity on investment by joint holders. The regulatory says that both the joint holders have to contribute in case where the investors are related to both the joint holders have to contribute if they don't have a joint bank account. And if you have an answer to this.
That's also operational in nature.
I think it's highly, very operational issue. We'll have to go to, it's a very down, we will none of us here will have the answers to your question. We'll have to go to an expert and get the answer to the situation. If regs are clarified, I don't know whether such a regulation specify anywhere, but maybe you have better knowledge on the matter that both have to contribute, because if you do equity shares and if you do demat accounts and even mutual funds, there are joint holders, but both don't have to contribute. But I'm not an expert on the AIF side. So it's best that the legal experts address the issue. And as Rohan said, if we can write to advocacy, we'll try to talk to our experts. But I think more importantly, I would request the member to talk to their own legal experts and get some clarity on the table.
Yeah.
Yeah, I think then we are done with the questions. Thank you, everyone, for joining us today.
Yeah, thanks everyone for your time. I hope we able to address and inform you what's happening on the advocacy side at IVCA and what we're going to work on. If anybody has any queries, so send it to advocacy.ivca.in, and we'll try to address your concerns. Thank you, everybody.
Thanks.
Thank you. Thanks, everyone.